Welcome to the Explainer. Sometimes you see two things that seem totally unrelated, like, say, geopolitical tensions in the Middle East and the price of pork in China. Well, today we're diving into a CICC analysis that connects exactly those dots. It's a perfect example of how global events can create these massive ripples in local markets. Let's see how they did it.
So, here's our game plan. We're going to start big with the global picture, this whole drama in the Strait of Hormuz. Then we'll zoom right into China's economy, which is sending some pretty mixed signals. From there, we'll see how that created some clear winners and losers in the stock market. And we'll even use the pork cycle as this really fascinating deep dive before we wrap it all up with the big takeaways for investors.
All right, let's start with a crisis that was grabbing headlines all over the world, the conflict in the Strait of Hormuz. And look, this wasn't just some regional issue, no way. It sent these massive shockwaves across pretty much every major market on the planet.
So to make sense of all that chaos, CICC analysts actually broke the whole thing down into 3 acts, like a play. Act 1, that was just pure panic. Then, in Act 2, the whole dynamic shifted, and you started to see this pivot toward negotiation. And by Act 3, with this fragile truce in place, the market's reaction completely flipped on its head, sparking this really broad rally.
And this right here, it just perfectly captures that wild swing in investor psychology. I mean, the market went from absolute fear, where everyone was dumping everything except for oil stocks, to this sense of cautious optimism. All of a sudden, taking on risk was back on the table, and it was tech stocks leading the charge.
Okay, so what's the really big takeaway here? It's that de-escalation isn't just about the price of a barrel of oil. Think about it. If oil gets back down to around $80, that could really cool off inflation. And that gives the U.S. Federal Reserve the green light it might need to start cutting interest rates later in the year. See? It's geopolitics directly influencing global monetary policy. A huge deal.
All right, so with that global drama as our backdrop, let's pivot and see how all this was playing out inside China's domestic economy. Because while the world was glued to the news from Hormuz, China's first quarter economic data dropped. And honestly, it painted a very mixed picture.
I mean, the headline number was a total showstopper. In that first quarter, China's exports just surged, growing by a surprisingly strong 11.9%. That was way, way better than a lot of people were expecting. But, and this is a big but, as the CIC analysts were quick to point out, this incredible number was more of a strong start than some kind of fundamental reversal of the trend. And to really get why, we've got to look under the hood at the domestic economy.
And what you find is this real tug-of-war happening inside China's economy. On one side, you've got strong government policy and those booming exports pulling things forward. But on the other side, the story at home is just much, much weaker. You've got households not wanting to borrow, and consumer spending is, pretty lukewarm.
So you've got this economy basically telling two completely different stories at the same time. Which of course leads to the big question, right? In a situation like that, how on earth did the stock market react? Where did investors actually decide to put their money?
Well, as you might guess, China's A-share market mirrored that economic split almost perfectly. This was not a rising tide lifts all boats kind of situation. Not at all. Instead, it created this really stark divide between the winners and the losers. And boy, was there a performance gap. It was huge. You had sectors like technology, media, and new energy just soaring. But then, on the flip side, consumer-focused industries and even farming, they actually posted losses. I mean, it really was a market of extremes.
So you gotta ask, what was the common thread for all those winning sectors? Well, a couple of key things. First, they were pretty much insulated from that oil price shock we talked about back in stage 1 of the Hormuz crisis. Second, they were the ones that benefited the most when that risk appetite came roaring back. And third, they were plugged into the really big, long-term growth stories, things like AI and the global expansion of Chinese companies, the going overseas trend.
But hey, despite all that drama we're seeing at the sector level, it's really important to look at the bigger picture for corporate earnings. And overall, non-financial companies are still expected to see their profits grow a modest but steady 5 to 10%. So it's a slow, gradual recovery.
Okay, now for a really fascinating part. Let's zoom way in to our most granular level, the pork cycle. Now I know it might sound a little random, but it's actually the perfect case study of that domestic weakness we were just talking about. It's this classic story of massive oversupply crashing into lackluster demand, and it really helps explain why that whole farming sector was struggling so much.
So, it all kicked off with supply. In the first part of the year, the number of pigs being slaughtered just surged by a massive 30% compared to the year before. 30%!
And that huge jump in slaughter volume led to a flood of pork just hitting the market. Overall supply was up 12% year-on-year in that first quarter alone.
So you've got this supply glut, and the result was exactly what you'd expect. And it was brutal. A complete and total price collapse. I mean, in March alone, pork prices just plummeted by over 35%.
But CICC does see a path out of this mess. The idea is that all the pain from the first half of the year is going to force producers to cut back on their capacity. Yeah, oversupply will still be an issue in Q2, but that reduction should start to pick up steam. The hope is that prices will finally bottom out and then start to recover by the end of the year, which would bring the big players back to profitability.
Okay, so after that whirlwind tour, all the way from a global conflict in the Middle East down to a pig farm in China, what are the actual takeaways for investors who are trying to make sense of this really complex environment?
All right, let's boil it all down. Globally, the worst-case geopolitical risks seem to be fading, but things are still pretty fragile. Nationally, China's economy is running on two different tracks. And in the market, that's created a very clear split. So the core message from CICC's analysis is this. In a market that's sending you so many mixed signals, the best strategy is to focus on sectors that are being driven by their own powerful, independent trends.
And that leaves us with one final and I think really crucial thought. When you're faced with this much complexity, this much noise, the analysis suggests the clearest signals to follow are the fundamental drivers. Where is the credit actually expanding, and what are the big industrial trends shaping our future? In other words, to cut through all that noise, you've got to follow the money and follow the technology.